Chartmasters, the official podcast of the International Federation of Technical Analysts, where the world's top market professionals share their experience, strategies, and timeless insights.
Each episode, we break down global markets through the lens of technical analysis, from classic price patterns to cutting-edge charting techniques.
Whether you're managing portfolios, mastering your first technical signal, or on a learning path, you're in the right place.
If you enjoy what you hear, don't forget to follow, like, and share this episode with fellow traders and analysts.
Hello, and welcome to the Chartmaster podcast from IFTA. We are very excited to have with us as our guest today, Larry Williams. I'm Zoe Bollinger. My co-host, Ron William, is with me as well. Larry is a titan in the industry, honestly, needs no introduction, but I'll give him a little one anyway. I was lucky enough to meet Larry many years ago as a kid, trailing along to some of the IFTA conferences. So it's really a pleasure to be here on the flip side with him. Many of you, I'm sure, know him through the indicators that he's developed, his writings, his success in trading tournaments. So we're really just lucky to have him with us today to share some of his fabulous stories, to share some of his wisdom and lessons learned through decades, seeing many different market cycles, a really changing world. So thank you so much for joining us, Larry.
Well, it's an honor to be here. Thank you, Zoe. And I do recall when you were, maybe 5 when we first met? I don't know. So,
I think that's right.
Come along. I think you've come further than I've come. I've gone downhill. You've come uphill. Yeah. So congratulations.
I totally disagree with that.
Maintaining, getting on focus in this business and going someplace with it. That's great.
Thank you so much. Maybe I'll let Ron kick it off with a question or two, and we'll see where we go from there.
Thank you, Zoe, and welcome, Larry. Our opening question, and we'll be tag teaming together just to build up the vibe and also carry on from our conversations from recent chats in New York. Larry, good to see you again, this time with the IFTA platform. The opening question as part of our IFTA Heritage initiative to recognize all the market veterans over the years begins with the backstory, origins and motivation. So the question we have for you, Larry, is you've said your trading journey began when someone told you a stock went up 2.5 points, enough to make $250 in a day. What was it about that moment that made you believe trading could be your life's work?
Well, it was actually stock went up 1 point, and that was $100. And in 1962, you could buy a car for $100. I mean, it's $100 now is like chump change, but back then that was serious money. So when I saw you could make $100 without going to work, I'm in. I thought, whatever this stuff is, I'm going to figure out how to do this. So it's just up or down. How easy could that be? That can't be very hard. And well, what I found is it's a little bit more difficult than that. But it was really just pure greed. Like, wow, this looks like a better deal than working. My dad had always told me, he said, son, learn to work with your head, not your hands, like I've had to do. And that kind of resonated, like, oh, if you just think about these stock things, maybe get right and go up 1 point. You could make $100 in a day, which is a huge amount of money back then. So, just pure greed. And a challenge, I guess, once I got involved, it became an intellectual and an academic challenge, which really grabs your soul at that point. That how do I beat this beast? Can it be beaten? And how do I do it?
It's interesting to hear you kind of spotlight those emotional extremes, greed and fear, the pendulum that swings in the market, and in each of us as traders and investors. And maybe to build on that, looking back to your early days when studying at the University of Oregon, did you ever imagine trading would become a lifetime pursuit, or did you feel like it was a temporary experiment at first?
Yeah, I think from my very first trade, I knew this is what I wanted to do. I thought I knew prior to that what I wanted to do and was set on that path. But once this thing bit me, it just became overwhelming. It still is, frankly. And it's maybe like an addiction. It's something that can be very good and can be very bad for you. And I've seen both sides of that. So, but this thing just grabbed me, and like I had no choice. I never knew this was the path that I was on. But obviously something was predestined in my life that I should end up here. And once I realized, because I tried a lot of other things, I made a lot of money trading. So I tried this, we owned a bank, we tried this, we tried that. None of them worked like trading. But I said, I think I'm supposed to trade. I'm not supposed to do all these other things that I thought I was so good at, and I really wasn't. And so I got back to, this is, like it or not, this is what I'm supposed to be doing in my life.
It's a poignant realization, and it'd be great to bring back Zoe. Zoe, over to you. The love-hate relationship.
It's funny you brought up that sort of intellectual challenge of the markets and can they be beaten? How do we beat them? That's something that really resonates for me also. It's one of the things that keeps you coming back. There's always curiosity. Can I tweak something? Can I get a little bit more out of it? What can I do? So I think that's a real piece of the curiosity that feeds me.
Well, look at all the books behind you, and you probably read all of them, and your dad wrote most of them. But it is there is like, I want to make a lot of money at this, but I think I have come from maybe a studying background. So once you get into it, you start studying and research, which was really helpful. I was working on my law degree actually when I really got involved in this. And there was a certain structure to the law, if this, then that. And I was able to apply that structure to the market analysis, which was really very helpful. And there's so much data out there, more now than ever before. But it is like, what really drives these prices? What really works in the market? All these books, a lot of them are bogus, some are really good. But that's why Ralph Vinson and I did the paper for the MTA, and to do really good research is an important thing. That's how you contribute. And it's been a great business for me. So you try to contribute in some fashion.
I loved that paper, by the way. The work on bloodbath and such was really, really interesting and sent me off on quite a tangent, I'll be honest.
What was scary about the paper is the paper, for those who haven't read it, said here's a way you can tell when a market's going to top out most all the time. Pretty good, really good indicator. Well, the paper just came out and we just had a sell signal. We thought, this is going to be so embarrassing, but it worked. It really worked. The market came down. We're like, is this going to work? We were like, we're going to have paint all over our faces here. And it worked. Like, that's an interesting thing. I've worked with a lot of people, a lot of students. I continue to get so many emails from people say, hey, Larry, this stuff really works. Like, will it really work? And it doesn't always work clearly, but it can work. This stuff can really work.
And I will say, I recommend that paper to anyone listening, because I think there's really, the work itself is great, and there's great food for thought as sort of offshoots from that work as well. But I'll play with the idea of, it works, it doesn't work. You are a huge contributor to technical analysis, but you're also a healthy critic of what some of its failings are and when it works and when it doesn't. Do you have some thoughts on kind of the limits of technical analysis, where pieces that most traders don't understand, kind of where it has something to offer and where you might want to supplement?
Well, I think there's two things going. I have been a critic of technical analysis, and I always will be, because there's a lot of bogus stuff out there. There might have been more when I started because we didn't have good research. We just had charts. That was it. We didn't have computers. We did everything by hand testing, and so people assume a lot of things about the markets that just weren't true. So, and where I think technical analysis fails is, as I understand the market, I could be really wrong on this, but my view is that markets move for reasons. They don't go from 10 to 100 because of a chart. Charts don't move markets. Conditions move markets. But technical analysis shows the swings along the way, when to get in, when to get out. It's not a driving force. It shows, if you look at a chart, it shows where prices have been. And I know when I took logic in college, one of the basic rules, you can't predict A with A. So we're trying to predict price with price. We have derivatives of that, like Bollinger Bands or percent R or whatever other indicators we have, but they're essentially price driven. So we get back to a logical fallacy of predicting A with A. So I try to use exogenous data to help me predict A, but price does have cycles. It does have form to it. So that's where technical analysis, I think, can really work on the structure and patterns of price.
Yeah, that makes sense. Do you have a sense of kind of, are there times where you decide to trust the technical signals versus are there conditions where you feel like technical analysis has less to contribute, or is it more that focus of looking at the trends that drive things and using TA to sort of consider your entries and exits within that overall trend or overall market condition?
Broadly, I think the best use of technical analysis is for timing, because I've got a market that's set up fundamentally. It's a Warren Buffett market, or commitment traders are very bullish on the market, and the market is going down. What I'm looking for, I like to ride trends. So I want to get aboard a trend. Well, fundamentals aren't going to tell me the trend has changed. They just say the conditions are bullish or bearish. So price action tells me the trend has changed. And then you go from hourly to daily to weekly to long-term moving averages, whatever. But to me, that is the real strength of technical analysis. I have a condition, the market should move. Now I have a trend change. Now I can get aboard. So whatever forms of technical analysis will help you identify trend change, I think can be really helpful.
That makes complete sense to me. Maybe I'll kick it back to Ron for a little bit of a chat about some of the multidimensional approaches you take to the market.
Thank you, Zoe. And back again. Larry, I have a question for you. Something that was super insightful in your presentation in New York just recently, where you were sharing market views in terms of traditional markets, but also fundamental analysis, but ultimately blending the two. And my question is, as part of that mix, as well as inter-market analysis, what's your view of that multi-dimensional view on what drives markets and how we can use that to trade and to make decisions?
What drives markets?
What drives markets and what helps you with your decision-making process for trading?
Well, let's talk first about what helps me, I think. And I think the one thing I've learned in 65 years of doing this is I am wrong so often. Big ways and little ways. So I have to prepare for that. Here's a great analogy. I played football in college, right? Every single play is diagrammed to score a touchdown. If this guy blocks this guy, this one blocks that guy, this guy runs here, every play will score a touchdown. They don't. Only about 3% of plays in professional football score touchdowns. So why? Because things happen along the way that you didn't expect, and somebody doesn't do what they did. So while we think we're going to have success, score a touchdown, have a winning trade, the reality is we don't. So we better really be prepared for that emotionally, as well as with stops in the marketplace and position sizing. When I first started trading in the 1960s, we had no idea of money management. It was like bet everything on every trade, or 50% of all the money you had on every trade. Well, then we found out that worked great when you're right. It's phenomenal. But when you're wrong, you lose everything. So I think a good example, Paul Tudor Jones talks about this too, just the yo-yo effect we had back then. And then we got into money management, which really is a misconstrued. Money management is really emotional management, because if you don't bet big, your emotions won't go crazy. So the way you control your emotions, if you're an over-emotional person, is with smaller bet size, because it doesn't affect your emotions as much. So to me, those are the really critical things. At first, I'm a warrior. I have to prepare for this battle, because I'm going to be in a battle with any position I'm on. I think I just went short or something. I just got no, not yet. But these things happen. And I'm going to have some loss in this trade probably. So how do I handle this? So dealing with the trade, handling a trade, it is really more important to the management of the trade than setting up the trade and getting into the trade. That's pretty much standard. Okay, we do that. Follow these rules. We're in the trade. But then all hell breaks loose. What do? You better have that figured out before you get into the trade.
And on that point of mindset and ultimately managing the trade, I've often seen, the conversations between yourself and son Jason Williams, and it's a good time to maybe spotlight his book, The Mental Edge in Trading. I read as part of that work, your lifetime experience of trading and the mindset of trading, but then also your interactions with Jason and the work that he's been doing and how that's influenced your trading. Could we maybe share some insights from you? How important is mindset and how useful has been the work that you've been doing alongside your son?
Jason was able to codify, I think, what makes great winning traders. All the research before has been done on losing traders. But Jason, who's a psychiatrist, John Hopkins educated, did serious research with very successful traders that I introduced him to. And we found these guys had some things in common. And they were really interested, not what we expected, by the way. Probably the number one thing that was not expected, these guys, some are billionaires, multi-billionaire guys, to a trader, they all had low confidence. And then I reflected on that because I've seen traders like, buy, sell, yeah, I did this, I did that. They always blow up because they're overconfident. And that was really surprising. These people have been, you'd think to be wildly confident, they've been so good, but their confidence level was not that high. So probably they controlled their bet size better. They were all very good with details. That's my huge weakness. I'm just horrible with detail work. I work so hard on it, but I still, details is my problem. The other thing that the highly successful traders were not very emotional people. Something would happen to them that would drive anybody else crazy. They go, yeah, okay, whatever. So you learn that you can't let your emotions fluctuate too much. Lose money, make money. It doesn't. You can't let it disturb you. You can't let it get you off path.
If I can build on that, Larry, and then I'll pass back to Zoe for a follow-up question. A lot of people ask the question about confidence and conviction. And clearly in trading, we do need to, we do need to have a sense of conviction with a high probability trade. How do you draw that line, or how do you square the circle?
Well, I think that it's a telling point, Ron. I appreciate that. I don't think money is the most important thing a trader can have. You have to have it, but the most important thing is to have confidence. If you don't have confidence, then you're not going to take action. You're not going to get in the ring and get into the battle. But part of that confidence comes from knowing, look, if I put a trade on, I'm going to only lose this amount of money.
Right.
So the confidence comes from the fact, hey, I got all bases covered here. This thing might blow up in my face, but come hell or high water, I have a stop here. I have position sizes my emotions can handle, and I have a place where I'm going to get out of this, hopefully with a profit, and that profit is substantially greater than my loss. So if I have those bases covered, I can be confident. I'd say, hey, bring it on. Let me throw some punches here. Let's get, because I'm ready for it. I've trained for it, and I think that's where confidence comes from. Correct confidence. The incorrect confidence, people say, oh, I'm so smart, I can do this, I got this all figured out. No, that's not good confidence. Confidence has to come from you're confident in your methodology. That's where real successful confidence of trading comes. I know this works. I've tested it. I know it doesn't always work, so I need these safeguards. Now I'm confident.
I really appreciate that point, and it's such a nuanced area, and particularly it's something we're talking about just pre-session, being able to change our mind as the market does what it typically does and adapts. I'll pass back to Zoe on that point of adaptation and some other areas that she wants to speak with you about. Zoe, over to you.
It's actually, I want to go back and kind of really highlight that idea of money management and position sizing, because it's something that my dad talked to me about very early when I was getting in the business. And, he has a line about never doing anything that's going to jeopardize your ability to come back and trade the next day. that it's, a privilege to be in the business. And I think as I talk to other younger traders, the importance of position sizing and the importance of money management and not putting yourself in a position where you're all in and you might not come back from it if your system doesn't work or if your safeguards aren't right. I think it's underappreciated, but really, really crucial. So I'm glad you highlighted that.
And I think when you're young, and particularly from my experience, when I was young, I don't care if I lose everything. I'm young, I can come back again. So my bet size that's why my early trading career, phenomenal wins. But it wasn't my skill and ability? Yeah, maybe a little bit, but really it was my bet size. My bet size was massive. And as long as I was correct, it worked really well. But when you're not correct, it will blow up. I know I had that happen. I learned the hard way. And I think that all traders want to make money today. They want to make a lot of money today. So how do you do that? You either trade a lot or you have big bets. And those are two things you have to be careful of. Over trading, because then you can't control things, or your bet is so big that you become too emotional and you can't handle the situation because you're emotionally committed to the position. And now you can't get out, even though you know you should get out. You know you're wrong, but your bet size is so big that it forces you to stay with the trade.
Yeah. Do you have thoughts on sort of stops are one of those that people are either die hard, need them, or I feel like they prevent me from trading? Do you, I know you use rules and structures that govern your trade and when you get in and out. Are you someone who uses stops particularly, or is it?
Oh yeah, I use stops because I'm a real weak person. I found my trading, if I don't use the stop, it'll come back, another day down. Oh, it'll come back, another day down, another day. I'm like, whoa, I got a margin call. That was my early day trading career. You know what? It's just easier to put a stop, especially now, Zoe. You're going up electronic markets and these pit session markets. It was crazy. People really could go for your stops. An interesting story that I don't think they did as much as people think they did. I had a friend who was the largest bond trader in the history of the world, Charlie DeFrancesco, a huge bond trader. And we were together one time talking about trades that was actually afternoon. We're trading for a Evander Douglas heavyweight fight in Las Vegas. And I said, he was placing orders, I was placing orders. I said, you're going for people's stops? He said, no. He said, I don't do that. I said, Charlie, how do you trade? He said, I wait till there's a lot of noise on the floor, a lot of action, and then I get aboard. If the market's going up and there's noise, I buy. If there's a lot of noise and the market's going down, I sell. I take a couple of ticks profit and get out. And he said, I don't want to go for somebody's stops. I want to go with the train in the direction it's going. So I think there's a lot of psychological, like, oh, they're going for my stops. Come on. Do you think they're really going after you? No. If you're getting stopped out a lot, it's because your stops are too close to the market. Care about you. But if your stops are real close, sure, you're going to get stopped out. So my stops tend to be a little bit away, not as far away as some people have written they are, but I'm going to give the market some room to breathe because, Zoe, I am not good enough to call the market to the absolute nth degree. I can't do that. So I need to give the market some breathing room. And my stops are there, especially in electronic markets. It just amazes me. When I started trading, they stopped trading the New York Stock Exchange every Wednesday because trading volume was 10 million shares. They couldn't process the order. Now that's not even a blink of an eye. So the depth of these markets, and I trade in size. I can get off huge amounts with click of the button. It's like no slippage in it, or maybe a tick slippage, big deal. So I think the markets are much easier to trade now. I missed the pit markets because of the opening gaps, but in terms of liquidity, execution, stop orders, this is a dream come true.
You've been through the full set of market environments, crashes, booms, inflation, and more recently all the algorithmic trading, digital markets. Are there things that have kind of stuck with you through that still work? Are there things that you used to love that you've kind of had to abandon as things change?
Well, I still have a love for systematic trading. That's what the big thing was originally, but Quite a few years ago, I was at the house of a multi-billionaire guy, one of the widely known traders on Wall Street, most successful, best trader I've ever seen. And on his wall, he had a Renoir painting that I studied when I was an art student in college, and he owned it. And I thought, whoa, I'm a mechanical trader. He's not a mechanical trader. I think it's time to switch. So that was my Renoir experience, that there's more money. If you're a good discretionary trader, you do better than a mechanical trader. So I became much more of a discretionary trader at that point in my life. And I think it's more successful.
Are there, in your experience over your career, what do you think's changed the most? Are there things that haven't changed at all?
The difficulty's still the same. That's for sure.
Yeah.
Well, I think it's easier to place orders now. And I miss that. My stockbrokers are my best friends. They were godfathers of my children. And we don't have that. Now my relationship is with my laptop. That's it. So that's a huge change. The wealthiest guys in town used to be stockbrokers. Excuse me. So not anymore. There's no money in being a stockbroker. So that's been a huge change. And that means no pit sessions, which means no opening gaps. So that's been a change we had to accommodate. The liquidity is now so much better than it ever was before. When I was trading bonds and size, I had to have different people on the pits around, right? So I'd have somebody here, somebody here. So they weren't looking at each other to make orders. And I had to have my orders in 3 or 4 places in the pits to get off 1,000 contracts of bonds. Now click is done. So things like that. But still the game is the same. Emotions drive markets, and fundamental reasons cause them to move. And the emotions are random. So we're dealing with randomness, which is essentially unpredictable to a degree at least. So we're still dealing with randomness.
Yeah. I will not hog the attention. I'll kick it back to Ron. I know he's got another couple questions for you.
Thank you, Zoe. Another one that's close to my heart is this whole journey of testing, throwing out the window, testing again, what works, what doesn't. But more specifically, this idea of a Holy Grail. And Larry, I'll be honest with you, when I started out, I was told that there is a Holy Grail. And now if I flip it back to you, you've spent significant time, resources searching for the Holy Grail, I can imagine, in the early days in trading, only to conclude that it doesn't exist. What was the most valuable insight that you gained on that quest, if at all?
Well, when I found the Holy Grail, that was it.
Well, in terms of the concept,
Where's the Holy Grail? Here it is, right here. I've got it hidden back here that nobody can look, right? No. Yeah, I think.
Well,
the W.D. Gann was an interesting person. I knew his F.B. Thatcher, who was promoting manager. I knew his W.D. Gann's son, John, met him in New York City. And I think, agree or disagree with Gann, Gann gave people this idea there's a Holy Grail, that he sold the absolute high of a market, bought the absolute low of a market. None of that is factually referenced, by the way. But people have that idea, there is a Holy Grail. There isn't. If there was a Holy Grail, look, I have friends that are multi-billionaires, numerous, that I trade with. They haven't found the Holy Grail, and they have a lot more money than I have to find the Holy Grail, and they have a lot more people, and they haven't found it. So this is a hard business. It's like going to work. My dad worked in a refinery. It wasn't fun. It was hard. Some things blew up in their face sometimes. Boilers would blow up. Valves would break. That stuff happens in any business, and it's the same in this. So, no, the Holy Grail is knowing that, look, I got a strategy. I've tested it. It should work. I'm going to trade it to the best of my abilities. There's no little black box that just sits there and makes money. You go, okay, I'll sit on the couch and drink brandy all day long and just let this machine make money. It's not there.
Well said. And through your own tried and tested experience, to build on that, I've often heard and experienced too, that as and when we do discover an edge, for those that can, it's for that moment in time until the market changes again. And I've heard the phrase, once you've found the key to the lock is changed. In all your years of trading, what's been your experience?
Well, I would disagree with that. I think there are things that do work and do hold up. Again, it's an imperfect world. Inside or outside of the market, it's an imperfect world. But yeah, there are clearly things that I think do hold up. 100% of the time, no, of course not. But once I understand that, I can trade accordingly. As you know, I'm huge on cycles. I think that's the interesting thing about cycles, which are part of technical analysis. Most technical analysis shows what's happened. Cycles shows what should happen in the future. So it gives a view of the future that we simply don't have. And I don't know of anything else that will show us a path to the future other than cycles. So I'm huge on a direction. I understand what the direction should be here now. Like shortly, we're going to have an up move in the bond market. In the middle of August, NVIDIA is going to start to have a nice rally. So I can be alerted in advance. So then when I get into the middle of August for a buy signal in NVIDIA, I can then start to look at my technical analysis or whatever you're looking at. Everybody has different arrows in their quiver. But I think it's a huge advantage to know, at this time of the year, we should see a rally or decline in a stock or commodity. And only that I know of, at least, Ron, only cycles do that.
Yeah. I share your passion and interest in the world of cycles, and also the fact that cycles work best with a framework, which you've always done, Larry. In that sense, where do you see the blend and the edge in blending the two?
I don't know that I have it all figured out, frankly, but the pieces seem to be, if I can have a view of the future. So when I get to that time of the future, I can look at the fundamental conditions, whatever causes markets to move. Then I can put a technical analysis on top of that to get me into the market, a trend change, and where my stop should be. So if I'm wrong, because I'm going to be wrong often, that my loss isn't going to be too big. And on top of that, when I make my bet size, the bet size that I can emotionally handle, I can emotionally lose this amount of money. I can't lose that amount of money. That'll just drive me crazy. But we all have different points. So to say there's probably the best bet size mathematically, I think, is about, to really be aggressive, is 4% of your account on any trade. That doesn't mean you should do it. It might be too much money for you to lose. You can't emotionally handle that. So you really have to find your emotional percentage where you can handle that loss and go and say, okay, fine. I'm not going to worry about that. But that's really how I see it. You get a view of the future. When you get to the future, find out if conditions are there, and then look for technical analysis to help you understand getting in and where to protect yourself.
Thanks for clarifying. Zoe?
I'm curious, actually, sticking with your cycles work for a second. You mentioned, a potential cycle in NVIDIA coming forward from here. Do you find that works better on individual stocks, overall markets, intermarkets, or kind of across the board successful? Do you find it particularly useful in one context or the other?
Well, I think it's probably, the best done if you have a lot of data. So we have stock prices back to 1700. So we have a lot of data there. I know what are the most dominant cycles. It doesn't mean they'll always work this year, but we know a pretty good idea. My forecast for 2025 said we should come down the first of the year and then rally the rest of the year. That's basically what's happened. Whereas a year ending in 5, years ending in 5, the decennial pattern for Medical and Smith, that's a bullish year, has been a bullish year. So for long-term cycles, stocks are really good, but I want to have at least like 10 years data. If I have that much, like Bitcoin's a little hard at first, but there are some natural cycles that even with like a couple years data, they're influences in markets, emotional influences that come from wherever, and we can find those. So for shorter term swings, maybe a month and a half, it's in the data. With a couple of years data, you're going to be able to find it. But it seems to be these emotional swings, Zoe, are there in stocks, in futures, and Bitcoin, which is something I've never traded. I look at it because all these young kids are into it. But and we may be fooling ourselves because things go up and down. So we call those cycles. And we think there's a driving force to the up and down. Maybe there isn't. Or maybe we can figure out all the cycles in the past, but can we carry that into the future? I think we can with some finessing of the data. Pretty reliable, we can do that.
Yeah, I think there's some pretty strong arguments that I think those cycles are real, especially it's human psychology in the markets, right? It's that fear and greed that drives us to get on board or get out. And I think that's quite hard to beat out of the markets because it's people behind it at the end of the day.
Well, I think that's where technical analysis is really helpful. At the low we saw this year, we got, because we had predicted market come down, then we're in a bull market. And we got emails, oh, Larry, the market's going to decline. It's the end of the world. No, that's when you got to buy. So technical analysis cycle said we're at a low. We should be a buyer here. And the emotions, oh, no, all the magazines, the Barron's, the Wall Street Journal, all the purveyors of pessimism that are always out there look like they've been right. So everybody believes what's been right recently and said, no, technical analysis was real clear. We're at a significant buy point here. And you have to override your emotions to be a good trader. That's, again, why really good traders don't have high emotional swings. They go, okay, market down. Good, I want to be a buyer. You need to learn to love weakness. And everybody's afraid of weakness. They get so frightened of weakness, they can't buy.
Yeah. Yeah, I think it's one of Walter Deemer's books that's titled, when it's time to buy, you won't want to. And I think
exactly.
That's fundamentally true.
But to me, I want to. Oh, I have a really good indicator. I'm going to call my panic indicator. This literally called virtually every market low. It's been a little early in a couple of them, but it's always been correct. We go way back to the turn of the last century. But when I guess I go, is it going to work this year? Yeah, come on, Larry. That's why you keep, if you keep the indicators, why don't you follow them? People keep the indicators and they get there and they go, oh, not this time. If you spend all this time doing percent R, Bollinger Bands, well, when it speaks, you better listen.
I think it's true. And it's one of the really tough things about the business is you do the work, the work should work, and you have to follow it. And it's, when people tweak those rules, they're like, oh, we'll wait and see, or we won't take this signal. It's when the real regret kicks in.
Well, and getting back to my football analogy, I think there's a lot of similarity here because one thing, football players do every Monday, every team reviews what the last game was. They look at their errors and they look at their gains and what they did right or wrong. And traders should do that. And they have a game plan. We should do this and we do that. We have game plans. We should do this and we should do that. And they don't always work out. But that strategy is important. And I think we can learn from athletics, especially about random things happen. Somebody pulls an Achilles tendon, so he can't run downfield where he should have caught a pass. So all these things happen. It's just like trading. But the interesting thing to me is how much time these guys spent on reviewing tapes. They actually spend more time reviewing tapes than playing football. And most traders don't want to look at their losses. It's hard to look at a losing trade. Oh, why did I do that? But you have to do that. You have to review your losing trades.
It's one of depending on your method, the reviewing losing trades, I think, is quite crucial. I hear people talk about doing trading journals and forcing themselves to go back and really review all of it. We don't do that specifically, but one of the things that we've always done is if you sell something, we look a month later to see where it is. And I think it's just useful to go back and see how good was your decision making.
Yeah, I have my trading journal. Every week I write my setup markets and daily what my plan are, and I can go look at it and see if I did it right, if I did it wrong, and maybe I can learn from that. So I think reviewing, it's easy to review a winning trade. It's so hard to review a losing trade. It's just not natural to look at when you mess things up, but you really need to do that.
Yeah, I think that discipline to actually do that is super important, and as you say, very hard. You've obviously
it is hard to look at your errors.
Prefer to bury them. You're a trader, but you're an author, you're a teacher, you're a system builder. Do you think the different roles have taught you different things about markets, about psychology, about yourself?
Probably so. That's a good point. I've never been asked that before. I think early when I was a big guy on systems, it taught me to really look at the minuscule part of the market, the little tiny things of the marketplace, and to really study. I think that's where my starting as an art student was really helpful, because you learn to look at blades of grass and look at an ant in the grass and the different shades on just one blade of grass. They're not green. There's maybe 15 shades of green and 3 yellows and 2 blues in there. So I learned to look at patterns.
You're not a detail guy. I disagree.
But that was art, like to look at all these little patterns. And so then when I started looking at charts, I go, oh, look at all these little patterns. I really got into the little patterns of the marketplace. And so I think that was a good background. But but working with people, I think, has been helpful, because it shows me how stupid all of us can be. Because we all tend to they make the same mistakes I make. If I make a mistake, you're going to make the mistake. So we all share that in common. So it helps me identify my own weaknesses when I see somebody else going, yeah, I've done that. I still do that. So that has been helpful. The other side of that coin is we've had a lot of students that have done really, really well, gone on to manage money, win trading championships. And I'm not going to take very much credit for that. What I tell them, I opened a door for you, a real dark room, and you went in there and you found the beast and you beat him. All I did was just shine a little light in the room. But enough light that we've seen a lot of success. So I know that this stuff is transferable, that I can teach this, which means it's just not, well, Larry's good. Larry has some natural ability. I don't have any natural ability, but this is information can be transferred to other people. And that's, I think, is really a telling point. It's not just like, oh, he's a really good athlete, but he can't teach people. Well, here's a good, Mark Spitz. Remember Mark Spitz, the Olympian, had won more medals, gold medals than any other Olympian would ever had before as a swimmer. Mark Spitz's coach couldn't swim.
Huh, really?
But yeah, really. And I have a high jump coach right now who couldn't high jump. And she's coached people, taking people to the Olympics. So if you learn that, can you teach people to high jump? Can you teach people to swim? Can you teach people to trade? Well, we don't know about trading. You can teach people to lay bricks. You can teach people to be a carpenter. Trading, that's emotional. It's all this other stuff. Well, because I've worked with enough people, and I have other friends that are educators. Your dad is a good example of it. Like, yeah, this stuff is transferable. Some people will become better bricklayers than others. But to learn from students that, yeah, this can transfer to other people, tells me that that there is science to this, or there's methodology to this. It isn't just randomness. There's more than randomness here.
Yeah, and I think it is teachable. There's always an aptitude piece to anything. I think, whether it's for a sportsman, not everyone can be an Olympian. There's a physical component to it and an aptitude, but I think it's teachable. And
not everybody. I mean, my dad was a great mechanic. He tried to teach me all this. I'm like, no way could I learn. I'm so embarrassing to him. And finally, I remember so clearly, we're in the garage in Montana, working on a car, and I handed him the wrong wrench or whatever. He probably said wrench. I didn't understand mechanics at all. And he turned to me and said, Larry, go have your mom teach you to cook. So I went in the kitchen, and so my mom taught me to cook. So some people can trade, some people can do mechanics, and some can't. The sooner you learn that this is not really for you, the better it is. Because you need to know, I have some skills at this or I don't. It's a really important lesson to know that. Can you do this or not?
Yeah, I think that's very true. I'll bring Ron back in maybe for a minute, and we've got a couple quick questions for you, a little bit of a lightning round.
You've been great with us, Larry. Super insightful, and we look forward to the feedback to follow. And as part of the climax, we wanted to do a lightning round. I'll kick off with the first question, and Zoe will tag team with the next. And hopefully you'll have fun through the journey. The first question is, what is the first chart you check in the morning?
The first what?
Chart that you check in the morning. Chart, market, indicator.
Probably whatever position I'm currently in.
Okay.
Answer. Is there an underrated indicator data series that you use? You feel like people don't pay enough attention to?
They're all overrated.
Fair enough.
Next one indicator commonly used that you think is just noise.
Just noise is on your chart. You have my percent R, Bollinger percent B, stochastic, and MACD. They're all the same darn thing. So that you're just creating noise. Just use one of them. I don't care which one you use. Doesn't matter. They're all showing the same thing. Each indicator in your chart should be for a specific purpose. One to show overbought or sold. One to show accumulation. One to show season. One to show timing. But everybody just puts, they read a book and they put all of Larry's indicators and John's indicators on. They're all the same thing. So each indicator serves a different purpose.
What's your best trade? Doesn't necessarily have to be the biggest winner, but one that you're really proud of.
Oh, my wife.
Ah, a good answer.
Without a doubt. Yeah, of course. In terms of trades, Zoe, I've had so many I really don't recall. I can recall my losing trades much better than my winning trades. And the winning trades, like, okay, great, it's winning trade, move on.
There's great insight in that. And to follow, what rule would you recommend that every new trader should follow, and particularly those who are tuning in and they're knee deep trying to work things out?
Learn to manage your money. Learn to manage your emotions.
What time frame do you trade in the most? Are you, especially when you started in these days, are you ultra short term? Do you hold stuff for months?
No, I'm kind of a slow thinking type of person. I use daily charts. I look at weekly charts for setups, longer term conditionals in the marketplace, but I trade off daily charts. I don't trade off intraday charts. I did that. You can make money out of it, but it's a tough business. I'm 83 years old. I don't need a 5-minute trade. I want to get a big trade in the marketplace. So I use daily bars, and I really most always have used daily bars and weekly bars to look at setups in the market. And that's my personality. And some people are really fast and do things faster. They might want to look at intraday stuff. But the problem, I think, with intraday trading, day trading, is the trend is the basis of all profits. If you don't have trend, you're not going to profit. The market needs trend to make up or down. Well, what's the function of trend? It's time. So a day trader has 4 or 5 hours to have trend. I've got months to have a trend move. So I can get you a huge trend move. A day trader's limit, he's got 4 hours to get your trend move. That's it. So it's already stacked the odds against him. So I don't want to look at these intraday relationships because there's no trend there of any great consequence. The whole secret to the market, my great mentor friend Bill Meehan said this years and years ago. It took me so long to figure it out. He said, the way you make money in the market, Larry, is you have a small position and catch a big trend. Yeah, you're right. If I have just a couple contracts on, I'm going to lose a little bit, but not much. But if I catch a big trend move, I make a lot of money. Well, a day trader, to make a lot of money, he has to have a big position on. And then he's out by the end of the day. So all the odds are against a very short-term trader. I want trend. I love trend moves. I need to capture trend, and that's a function of time. So time is my ally. It's not my enemy.
You know what? I'm going to follow up with the next question, but with a twist on what you just said, Larry. So strong trend with strong volatility, crypto market, which is top of the headlines right now with Bitcoin being at all-time highs, Ethereum outperforming significantly, but also with the so-called Genius Act that just got released and what that might mean for the industry. In your perspective, from a market view, trading-wise, crypto, real asset, trading vehicle, or bubble to burst?
Well, I don't understand crypto. It's probably because of my age. I don't understand a lot of things anymore. I don't see there's any value to it. I can't go in the store and buy something with a cryptocurrency, whatever these things are. So to me, it's either it's going to blow up, or there has to be some real change. And the change I would look for is when suddenly I can go buy a car, I can buy dinner with my wife with the crypto, whatever these things are. And the problem that I see is that, as I understand, these things fluctuate a lot, right? Zoe, they go up and down quite a bit. So if I go in to buy dinner, it's one crypto coin, but the price of crypto coin has gone up or down, the guy's not going to want me buying crypto coins because they're not a stable market for him. So until it becomes a stable market, to me, it's a great trading vehicle. If you want to be a trader, trade these things like crazy, which means it's an emotionally driven market. It's not a fundamentally driven market. It's all about emotions. Why cycles work so well in cryptocurrency stuff. It's all emotion. So think about what you're trading here. Is there a real end use to this, or is it just an emotional binge that we're seeing right now? It may turn into something. If it does, it's when you can actually buy things with all this fake currency that they created.
Is there one book you think every trader should read? Might be a trading book. One of yours might be something totally different topic.
Yeah, I've always told people read the Zurich Axiom. Zurich, like the name of the town in Switzerland, AXIOMS, Zurich Axioms by Max Gunther. I think it's a great read. It will disrespect a lot of what I do, cycles and forecasting and stuff. I think it's good to read the other side of the coin, and just a lot of wisdom in the book. I particularly enjoy that book.
And in the final two questions that we have, one for me and then back to Zoe. One mistake new analysts or traders should be careful of. One mistake. You've mentioned a few, but there's one that comes to mind.
Don't believe in too much in yourself. Believe in the market. You're going to be wrong. So the best belief system is I will be wrong. When I put a trade on, I assume it's not going to work. I don't assume it will work. So if I assume it's not going to work, I protect myself. So just don't believe too much in yourself. Believe in protecting yourself.
Yeah, I'm thinking about the book title from some time ago. Being right or making money would be the flip side of that thinking.
Yeah, they're two different things. You don't have to be right very often to make a lot of money in this business.
Well said.
But you can be wrong just one time and lose a lot of money. That's for sure.
You may have just answered my last question actually beautifully with that, but one life lesson that the market's taught you.
Actually, been quite a few life lessons. I think the biggest one is that when I started out as a kid, I was pretty cocky and full of myself and probably not a particularly nice person. And the markets have really taught me the importance of humility because humility is a great educator. It made me a much better trader and prognosticator of the markets because it made me realize I had to do better research and more research. I couldn't just go on my self-inflated ego of myself. That it was a great learning experience. And the biggest lesson of all, I guess, in the stock market from my friend Vince Niederhofer is the trend is up, guys. There is upward drift. There's no upward drift in commodity markets. You need to differentiate those two, Zoe. The commodity markets are boom and bust, oversupply, undersupply. Stocks have upward drift to them, and you better not stand in the way of that upward drift unless you have really strong reasons to do that. There are times to be bearish, but that's not the majority of the times. You have to be very careful turning bearish in the market.
A great point, truly.
Lots of food for thoughts and key insights. Larry, thank you so much. And to close, it would be great just to share any final insights with our audience. It's primarily IFTA oriented in terms of technical analysts, but also traders across the world. What would you like to share with them about top of mind thoughts or insights?
No, just be careful. Enjoy this. Just find this an enjoyable thing to do. And then if you get really good at it, you can get more serious about it as a money manager, a career, or whatever. But start this as a hobby and just enjoy it. Don't make this thing so destructive of your life that it becomes an all-consuming thing. You start out just enjoying this. It's a fun thing. The interesting thing to me, at my age, I can still do it. So this is something you can do forever almost, it seems like. So, yeah, add this to your repertoire in life. It's a new life experience for you. And a life-changing experience. Certainly was a life-changing experience for me.
Well, thank you so much. This has really been fabulous. We appreciate your time, your wisdom, your stories, and it's been a pleasure.
Well, I think there was more time than wisdom, but thank you for having me there. It's always an honor when somebody says, hey, would you come speak to us? It's very flattering, and I like that. Thank you very much for having me.
Thank you.
It's been a pleasure. Thank you, Larry.
Thank you.